Today, we're stepping into the ring for an Insurtech title fight that's been brewing for years. In one corner, you've got the visionary disruptor, LMND, and in the other, the comeback specialist, Root. Both are trying to completely upend one of the world's oldest industries.
I mean, let's face it, for centuries, insurance has been kind of slow, super complex, and honestly, often a frustrating business. It's an industry that was built on paper, on old school processes, and on legacy systems. But now, there's this new breed of company. They're armed with AI, with big data, and a mobile-first mindset, and they are here to challenge the status quo. LMND and Root, they're two of the biggest names leading this charge. But here's the thing, they're taking wildly different paths to the top. So the big question is, if you're looking at this from an investor's perspective, which one is the smarter bet over the next, say, 1 to 2 years? Well, we're going to break down their strategies, their tech, and their financials to figure that out. Let's get to the tail of the tape. Okay, first, let's meet our contenders. In this corner, you've got LMND, the visionary. They're building a one-stop shop for all your insurance needs, renters, pet, home, auto, all of it, wrapped up in this slick, super user-friendly app. Their whole game plan is to get customers when they're young and just grow with them for life. And on the other side, you have Root, the specialist. They have this single-minded obsession, fixing auto insurance, using data straight from your phone to price policies based on how you actually drive. All right, ding ding. Let's get to our first round, profitability. Look, for any insurer, this is the main event. You can grow all you want, but if you're losing money on every single policy you write, you're just not going to last very long. And the way we keep score here is with one key metric, the combined ratio. It's actually pretty simple. You add up all your claims losses and your operating expenses. Then you divide that by the premiums you collected. If that number is under 100%, congratulations. You're making a profit on your core business. It really is the ultimate report card for an insurer. And this is where it gets really interesting. In the second quarter of 2025, Root kind of shocked everybody by getting its combined ratio down to around 95%, which means they officially crossed that profitability finish line. LMND, while they're making great progress, is still above 100%, meaning it's still paying out a little more than it's taking in. And just to be clear, this is not some theoretical win for Root. That sub 100% combined ratio translated directly to the bottom line, a $22 million net profit in the second quarter. They have proven the model works. They can make money. Now, to be fair, LMND is absolutely heading in the right direction. Their loss ratio improved significantly, which is huge, but they haven't quite reached that profitable promised land yet. There's still some execution risk there. While Root, well, they've already planted their flag. So for this round, you've got to give the win to Root. Okay, on to round 2, growth. Both of these companies need to scale up, big time, but their playbooks for getting there couldn't be more different. LMND's strategy is that classic land and expand. They hook young customers with an easy, super low-cost renter's policy. Then, as that customer's life evolves, LMND is right there ready to cross-sell them pet insurance, then home insurance, then auto. Root, on the other hand, made this really dramatic partnership pivot. After burning through cash on expensive ads, they slammed on the brakes and totally shifted to getting customers through partnerships with big companies like Hyundai and Carvana. And this journey right here, this really illustrates LMND's long game. They might only acquire a customer once, but they plan to monetize them over decades. That initial renter's policy might seem small, but when that same customer later adds a car and a house, their value to LMND just explodes. It is a really powerful model for lifetime value. And the results of Root's big pivot? Well, they're pretty clear. A massive 44% of their new business is now coming through these super efficient partner channels. This lets them grow without spending a fortune on marketing, which you might remember was a huge problem for them in the past. It's just a leaner, much more sustainable way to scale. So when we look at the size of the prize they're fighting for, LMND is playing on multiple fields at once. You've got home, pet, auto in the US, and they're even expanding across Europe. Root is playing on one, absolutely massive field, the $266 billion US auto insurance market. So LMND has more ways to win, but Root has a singular, intense focus. All right, it's time for our final round before the verdict. Technology and capital. Because in the world of Insurtech, let me tell you, your algorithms and your bank account are your most important weapons. They're your knockout punches. When you think about Lemonade's tech, their advantage is probably most famous in the claims process. Their chatbot, AI Jim, handles a huge number of claims without any human ever touching them. I'm talking 30 to 40% of claims resolved instantly. This doesn't just cut costs like crazy, it also creates an amazing customer experience. And to power this whole vision, Lemonade is sitting on a massive war chest of over $1 billion in cash. This huge capital cushion gives them plenty of runway to grow, and it minimizes the risk that they'll have to raise more money down the line, which could dilute shareholders. Now, Root's tech edge is different. It's a deep, deep data moat. They have collected over 32 billion miles of driving data, and that allows them to price risk with a kind of precision that traditional insurers just can't match. They don't care so much about your credit score. They care about whether you slam on your brakes or text while you're driving. And after what was, let's be honest, a near-death experience a few years ago, Root has successfully stabilized its finances. They now have over $640 million in capital. Now, it's not as big as Lemonade's, but when you combine it with their newfound profitability, it is more than enough to execute their very focused strategy. So, after 3 intense rounds, who comes out on top? It's time to go to the final scorecard and deliver the verdict on which of these companies offers the better risk-adjusted return right now. Okay, looking at our scorecard, wow, it is a split decision. Root clearly takes the win on profitability since they've already crossed that critical line. It also gets the win on valuation and near-term catalysts, which we'll get to in a sec. But Lemonade wins on its superior unit economics, that powerful land and expand model, and of course, its fortress-like capital position. Now, valuation. This is where the story gets really, really interesting. The market has awarded Lemonade a premium valuation. It trades at about 3.5 times its earned premium. That's the money it's actually banked. Root, on the other hand, trades at a deep discount, at just half of its written premium. That's the total policies on its books. The market is still skeptical. It's basically saying, show me, which creates some significant room for Root's valuation to grow if they keep executing. So the crucial point from this analysis is this. While Lemonade may have the grander long-term vision, for the next 12 to 24 months, the source analysis concludes that Root has the edge. It's already profitable, its turnaround is clearly gaining steam, and that lower valuation provides a greater margin of safety and more room for upside. But of course, this is all just a snapshot in time, right? The long-term question is still out there. Will Lemonade's grand, multi-product vision ultimately create more value in the end? Or will Root's laser-like focus on just perfecting one massive market prove to be the winning strategy? Well, that is the multi-billion-dollar question the Insurtech war will eventually answer.